Welcome to a Practice Pro CPD, brought to you by LAWPRO.
Welcome to our program today. Today we have Vanessa, Tanis, and Ray and Brennan who are going to share their expertise and knowledge with us. My speakers, if you want to go off camera for now, and then I will call you back when it's your topic. I'm going to start with a land acknowledgement. So I'm speaking to you from Toronto, which is also where the offices of LAWPRO and the Toronto Lawyers Association are located. I'd like to acknowledge that Toronto is on the traditional territory of many nations, including Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples. Their stories and their dreams and their spirits linger in this very soil beneath our feet. We honor their enduring connection to this land, a connection that has shaped this incredibly beautiful, vibrant city. For those joining us remotely, we acknowledge that you may not be on the traditional territory. You may be on the traditional territories of other Indigenous peoples. We extend our respect and gratitude to all of these nations who lived and live on these lands for sharing them with us peacefully. My name is Sophia. I am Communications Counsel at LAWPRO and the moderator today. We have 4 speakers joining us today, and they're going to share their knowledge and expertise. As I just mentioned, we're joined by Tanis, Vanessa, Brendan, and Ray. I will reintroduce the speakers with their titles right before their topic. If you're interested in knowing more about the speakers, the bios are in the materials at the very end. Very impressive bios, by the way. This program is divided into 4 main areas of discussion. First, we're going to talk about the new FINTRAC requirements for title insurers and how that impacts you. We're going to talk about cybercrime, then non-arm's length title transfers, and acting on real estate transactions involving separating spouses. We have also put together materials. The materials the link is in the program chat, I believe. So we'll get started with title insurance. Title insurers are now subject to new AML obligations. And since the new rules came into effect last Wednesday, October 1st, most of you or all of you already know about this and have probably made some adjustments. But we thought this would be a good opportunity to provide information that gives more context to the changes. Brendan Fagan, Chief Underwriter, Director of Underwriting at Title Plus, is going to share this information with us.
Good morning, everyone. Excuse me. Thanks a lot, Sophia, for that. I'm Brendan Fagan, and I'm here on behalf of LAWPRO's Title Plus program, where I'm the Chief Underwriter. Well, not the most fun topic or interesting one, I'll be presenting today about the new federal anti-money laundering requirements applicable to title insurers that just went into effect a few days ago on October 1st. The announcement that title insurers were being brought under the federal AML and anti-terrorism financing regime has understandably been met with a degree of apprehension by the real estate bar. It sounds complex, burdensome, and like another administrative task in an already demanding type of practice. My goal over the next 15 minutes is to demystify potential misunderstandings and clarify the nature of these new requirements. I wanted to try to provide a clear, practical overview of what's changing, what is not changing, and most importantly, what this may mean for your practice when you're ordering an owner's title insurance policy. While this is a significant change for us as a title insurer and for the industry worked diligently with the government to ensure that the impact on you, our partners, is as minimal and as manageable as possible. In terms of some background, it was effective October 1st that the title insurers became what's known as a reporting entity under the Federal Proceeds of Crime, Money Laundering, and Terrorist Financing Act. This change places us under the supervision of the federal agency known as FINTRAC, which is Canada's financial intelligence unit. Its mandate is to help detect and deter money laundering and terrorist financing by ensuring that reporting entities comply with those legal obligations. And this is part of a broader federal strategy to strengthen Canada's AML regime, particularly within the real estate sector, which has been identified as being vulnerable to money laundering activities. And the government's goal is to close perceived gaps in the financial system and to align Canada with the international standards. It's important to distinguish this new legislative regime from what the Supreme Court of Canada ruled on in 2015. The case from back then affirmed that directly applying this act to lawyers was an unconstitutional infringement on solicitor-client privilege. These new rules do not impact that. The obligations this time fall on us, the title insurers. Your involvement as lawyers is indirect, stemming from the practical reality that you are the conduits between the clients and the title insurers. We'll now start to discuss the new landscape and what the key changes will look like for your practice. The most significant change for you as a practicing lawyer is the creation of a limited agency relationship with the title insurer. Because we as title insurers do not have direct contact with your clients, the government has permitted us to rely on the purchaser's lawyer to act as agent for the sole and specific purpose of verifying the purchaser's identity. To formalize this relationship, Title Plus has incorporated an agency provision directly into the subscriber agreement that we have with our customers. And this is a one-time acceptance. Lawyers who have ordered from us since these rules took effect have already completed this step. And for new or infrequent users, you'll be prompted to accept the updated agreement prior to your next order of an owner's policy. The primary concern with any agency role is the question of liability. To be clear, the agency agreement is structured to ensure that you are not taking on our liability for the AML compliance. The agreement includes a comprehensive indemnity clause where LAWPRO agrees to indemnify and save you harmless from any liability or costs that may arise from you acting as our agent. For actions taken in good faith, you're protected. The only exception is for your own willful misconduct or fraud, such as knowingly providing false information. Your specific duty in this role is to perform the client ID verification. And after verification, you will then provide the title insurer with the information that you obtained and that you use to verify the client's ID. It's crucial to understand that this role does not create a solicitor-client relationship between you and the title insurer, nor does it create a conflict of interest with your duty to your purchaser client. Your function as an agent is strictly limited to the non-legal task of performing ID verification on the title insurer's behalf. The agency role requires us to be precise about how these roles interact with your professional duties, specifically confidentiality and solicitor-client privilege. It's important to distinguish between the two. The information we require, a client's name, date of birth, etc., is definitely confidential. However, this type of factual information is generally not subject to solicitor-client privilege. Privilege specifically protects communications made for the purpose of giving or receiving legal advice. And it's because this information is confidential that you must obtain your client's consent before sharing it with us. This is a crucial step that authorizes the disclosure. Obtaining informed consent is critical both for lawyers and for title insurers. As a lawyer, you have a professional duty to secure your client's consent before sharing their personal details. Correspondingly, as a title insurer, we have a legal obligation under privacy legislation to ensure that this consent is obtained from our insureds. Before you share any client info with us, you must have this authorization. The Law Society of Ontario has been clear on this point. Your client needs to understand what information you are sharing, why you're sharing it, and that this information could ultimately be shared with FINTRAC if a transaction is deemed suspicious. To assist you with this, Title Plus and the other title insurers have provided precedent consent forms that you can adapt and use in your practice. We strongly recommend incorporating this into your retainer process for all new purchase files. I'll now break down what the shared information is. The federal regulations impose two distinct categories of information gathering duties on title insurers: record keeping and identity verification. Many of the new record keeping obligations are straightforward. They involve details that title insurers have always been collecting as part of the underwriting process, such as the property address, legal description, and purchase price. What's new is the requirement to formally record certain details that were not previously required, such as the purchaser's current address. The truly novel requirement, however, is the identity verification. The specific steps you must take will differ based on whether the purchaser is an individual or an entity. It'll now outline the requirements for each. For individual purchasers, the new federal IDV rules will closely align with the existing Know Your Client requirements imposed by the Law Society. As a result, the information we require is information that you would typically have in your file already. Specifically, you'll need to provide details such as your client's current address, date of birth, the type of ID document, for example, driver's license or passport. You'll also need to provide us with a date on which you completed the verification. When the purchaser is a corporation or another type of entity, the verification process shifts from identifying a person to confirming the legal existence of that entity itself. Under the federal rules, title insurers must obtain an official record that confirms the corporation's existence and that contains its name, address, and the names of its directors. The most reliable and efficient method to meet this requirement is to upload in the online order form a current corporation profile report. While other records, like a certificate of incorporation, may seem sufficient, they often fail to confirm the corporation's active status and may not list the current directors or the current address. It's important to highlight a key distinction here between the LSO requirements and those of the federal government for corporations. The federal requirements for title insurers are significantly less burdensome. Our obligation is limited to verifying the corporation's existence and obtaining its address and names of the directors. In stark contrast, the LSO has a multi-step due diligence process, including, for example, verifying the identity of each individual who's authorized to give instructions on behalf of the corporation, making reasonable efforts to identify the beneficial owners who control 25% or more of a company, and taking reasonable measures to confirm the accuracy of the director and ownership info that you obtain. Luckily, title insurers have been explicitly exempted from these more complex requirements. For non-corporation entities, such as partnerships or trusts, typically a copy of the foundational document, like the partnership or trust agreement, will be required to verify the entity's legal existence. This data collection serves a critical purpose beyond just record keeping, as it ties directly into our legal obligation to report suspicious activity, which I'll now briefly discuss. A critical part of the new AML regime is the legal duty for title insurers to report certain activities to the government. This is done by filing a suspicious transaction report, or STR, with FINTRAC. The requirement to file this document is not discretionary. It's a legal obligation. The threshold for filing is met when a title insurer has reasonable grounds to suspect that a transaction is related to the commission of money laundering. FINTRAC considers this a crucial part of the AML framework. As a lawyer, a question you may have is what triggers the title insurer's duty to report? While the legal standard is broad, the trigger for a title insurer is typically or is focused on our role within the transaction. So for example, during our underwriting process, if we uncover red flags of fraudulent activity related to the property's title, involving a concern of suspected impersonation of an owner, that may trigger the STR obligation. In terms of whether or not you would know that a title insurer has filed this kind of report relating to your client, the answer is no, as reporting entities are not permitted to disclose this information. This is known as the tipping off rule. It's a legal requirement that's universal across all reporting sectors. Now I'll turn to what the policy order looks like in practice. As the changes to the ordering system itself are fairly straightforward. When you place an order for an owner's policy on a purchase, You will see new mandatory fields that come up in the Title Plus system to input the required IDV information for individuals or an upload field for the corporate profile for reporting entities. The policy cannot be issued until this information is provided. We recognize this is a new process for both your practice and for us as a title insurer. And the onus is on us here to ensure that it integrates into your workflow as smoothly as possible. Since these rules came into effect just a few days ago, we have actively been gathering feedback from lawyers on a daily basis. We're committed to continuously improving our platform to make this new requirement as efficient and unobtrusive for your practice as possible. It's also important to remember that these requirements apply only to purchase transactions. Mortgage-only deals are typically not affected by these rules. Having reviewed all of this information, let's recap the essential takeaways for your practice. Here are the three ones that I'd like you to keep in mind. The first is a limited agency role, where you will be acting as a limited agent for the sole purpose of collecting IDV information. This is formalized through an updated subscriber agreement. Next is the mandatory client consent, where you must obtain informed consent from your purchaser clients before sharing their ID info with us. And we encourage you to adapt the precedent consent forms that have been provided by the title insurers into your own retainer agreements or into other documents that you use. Thirdly is the new information requirements. The order form is designed to be straightforward. For individuals, it's providing the key details from their ID document. And for corporations, it's uploading a current corporation profile report. To close, I'll leave you with just a couple of final thoughts on the shared path forward. We recognize that integrating these steps into your practice is a change and a challenge. It's one, however, that the government has deemed as necessary to combat financial crime and to protect the integrity of the real estate market. Our commitment from us at Title Plus and LAWPRO is to support you through this transition. We will work to provide clear guides, precedent forms, and we have a dedicated team ready to assist you. We've worked diligently to implement these mandates in a way that respects your vital role in the transaction and is as efficient as possible for your practice. We remain committed to continuously improving as well, especially based on your feedback. All right, everyone. Thank you very much for your time.
Thank you, Brendan. Thank you so much. Next, we're going to talk about cybercrime. If you've been to one of our past CPDs, especially ones that are geared to the real estate bar, you know that we talk about fraud, cybercrime, social engineering regularly, if not every single time. It's one of those topics that's not like a new law and we're going to adapt and we're going to be fine. This is ongoing all the time, which is why we have to address it. So I will turn it over to Raymond Leclerc. Ray is VP of Public Affairs at LAWPRO.
Thank you, Sophia, and I think you just presented my whole argument.
Sorry,
Let me try to go into a little more details. So good morning. I'm going to speak about cybercrime and social engineering specifically, that basically talk about the risks, and hopefully if we are able to identify the risks, then we can avoid them. And that's what my mission is today, is hopefully have you identify the risks that are out there and not fall prey to them. Cyber risk, mostly fraud, I compare very much to a roller coaster. The incidence of attempts go up. People are not suspecting get caught. And the more lucrative it is, then the more the fraudsters do it. The more people become aware of it, the more they safeguard against it. The success rate goes down, and then so the fraudsters stop using it. And everybody thinks, oh, it's gone. No, it's not gone. It just disappears for a while. People now become complacent and think, oh, it's gone. And then the fraudsters start increasing it again. And then again, people get caught on the way back up. And it's a continuous up and down. And so think of fraud as never going away. It may become dormant for a while, but basically it does not go away. It's always in cycles. The internet cites cybercrimes as being the business email compromise, which obviously we see and we want to guard against. The exploitation, the jacking, and the bullying are some things maybe we will help our clients with. The espionage, the extortion, the ID theft, and the malware are things that basically we need to be cautious of, that we need to be aware of, and that way we may become a dupe in somebody's scheme. As I say, we see all kinds of fraud, mostly phishing attempts, bad check. The bad check was one of the first fraud that we started going out with. And people say, Ray, why are you still talking about it? Because lawyers are still reporting having been caught with a bad check and having sent out money. And as I say, it's the roller coaster effect. So we need to keep emphasizing it so that it doesn't get too far in the memory that we forget about it. Wire fraud, of course, is the flavor of the day. That is the one we're mostly seeing today, and we need to be careful about. Of course, we see it in real estate scams and corporate scams. Internal frauds do not go away, unfortunately. Sometimes our trusted staff are the ones that will stab us in the back. So we need to be able to have systems in place that will verify, even though they are the trusted staff. And I want to talk about specifically social engineering. What is it and how do we safeguard against it? Well, social engineering is a whole science of basically how do they manipulate you or coerce you into giving them information or clicking on something to get into your system. They're looking for passwords, they're looking for usernames, they're looking for all kinds of different things. The interesting thing is it could be the lawyer who's targeted, it could be the client that's targeted, it could be a staff member that's targeted, anybody in that network. In fact, we've seen third parties being targeted who are part of the deal. The real estate agent, the broker, the mortgage agent, and so on and so forth, that are all part of it. They get into their systems, and then that's how they get into other people's systems. Why does this happen? It happens because we are human. The whole the science of social engineering is how do they use greed, trust, fear, ignorance, curiosity, laziness, and anger, characteristics we all have, some to greater degree than others, but basically we all have. And there's a science that says if you do this, then that will get that person to respond. And they will try a number of different things to be able to engage with you and basically use your frailty against you. And so we have phishing, which is one of the biggest things we see these days. It started with phishing, which is email scams. Of course, the younger generations are not into email, they're texting. And so now we have smishing. Generally, the older generation is not doing either of those. They're using the phone. And so now we have vishing for voicemail. And now the newest thing with technology is now we have QR codes. And with QR codes comes quishing. Basically, all the same thing. It's a message that you think you should trust. It's something asking information of you, either to provide some information or to give them access or something. But again, it's a way to make you believe that you are providing some valuable information to somebody that you trust. And of course, then they're using that against you to get into your account, to get into your bank, to transfer money, etc. And it's unfortunately something that we see every day. And so basically what we have is the funds redirection scam. Basically, there's an email that goes out or some kind of a message that goes out to somebody and say, oh, by the way, send the money here. And of course, traditionally, lawyers have been, I've got an email from the client, I've got it in writing, print it out, put it in a file, send the money. That's not good enough anymore. And we started with a call before you click campaign, which was before you send the money by wire, because it's you cannot reverse it. Basically, the idea is call to make sure that banking information is verified. And you should do so for the clients. You should have the clients do it also for you. Now, that wasn't enough. Because of the social engineering goes even further. And as an incentive, we put in a new provision, but as an incentive to get people to cooperate, we basically, and to protect your policy. LawPro could always insure you for whatever you want. It's how much premium do you want to pay? And as you know, we're supposed to be operating in commercially viable fashion. And so basically we decided that we would reduce the coverage if you do nothing. But if you follow some very easy steps, you maintain your $1 million per limit coverage for social engineering. What is it that you have to do? Basically, it's a retainer stage. Whatever that process is, we want in writing for you to exchange with your clients banking information. What bank account will you receive monies into? What bank account will the client receive monies into? Record those numbers. The earlier in the relationship, the better. The idea is nobody can get in between. The fraudsters can't get in between. They can't send you an email to say, oh, here's my account, because you already have the account. The next stage is to basically warn them that if there's a change to that, they should independently verify that change. So if your staff, if your office, if you get information from the client that is different, you get an email or something, then you need to contact them from a secure number to get that information. You should basically advise the clients the same thing. And so if you do that, if you contact the clients, you put it in writing, you advise them to check with you before they change, then you are covered. We do provide you with a form, basically, that you can review to verify the account numbers and so on. And you could do that once, put it in a file. As long as it doesn't change, then you don't have to do so again. The funds checklist is provided, and that way you can follow up where you're going. Some questions that we've received, lawyers have been saying, well, I'm not comfortable giving out my bank account information. Well, every time you send a check out, you're giving your bank account information. So not really any different. And the fact that I have your account number doesn't mean I can pull any money out. I can put money in, that's true, but I cannot pull money out. And so that should alleviate some of the fears. Some lawyers will say, well, I don't need to give my general account because it'll be trust monies that are coming in. Well, we've had situations where clients have received a bill from their purported lawyer saying, here's the amount for the transaction, here are the fees, please pay. And the client has paid. Unfortunately, it was paid to the fraudster's account. What are the chances the lawyer is going to be paid now for those fees? Because the client is simply going to say, I've already paid it. You didn't provide, you didn't help yourself. So very important that we give not only the trust account details, but also the general account. You do not need to provide anything to LAWPRO. You do this, it's basically between you and your client. You exchange the information. You make sure you have a valid way of contacting, formal way of contacting each other, and that's it. Now, if there's a claim, yes, we will ask you, do you have that information in writing? If you do, then you get full coverage under your policy. We have a full toolkit. The toolkit basically shows you what is required, shows you the language that we're looking for in the retainer. Although you don't have to use that retainer form, you can create your own. Again, it's the important thing is the exchange of the banking details, the specific bank account that you're putting money into, or that you'll be receiving money. The checklist is there. Frequently asked questions are there. There's also a video there of explaining the whole situation again, if you want staff to review it, or if you want to remind yourself as to what is needed. Just a reminder on ID theft, as it is one of the major issues, is to remind it, this is not a copy and file exercise. So many times the receptionist has the instructions, client comes in, get their ID, photocopy it, put it in a file, and nobody looks at it. We've had a claim where the lawyer says, I was dealing with a man, and yet the ID is clearly of a woman. Nobody even looked. How that happened, no, not quite sure, but it's not just a copy and file. You have to review it. The driver's license, very easy to mimic them, and so we have to be careful. But look at some of the indications you have. Does the picture look like the person that you have, that you're dealing with? Is the signature that they're using, similar to the signature they have on their card. Is the number right? The first letter is the first letter of the last name. At the date of birth right. And also interesting, I didn't know this, but a woman's driver's license, the month is different than a man. A man, they will use 01 for January or 11/11 for November, but in a female, they will use 5/1 for January and 6/1 for November. So if you get a man with a 6/1 for November, then you know that it's fake ID. There is a search capability with the province of Ontario. Unfortunately, they only give you valid or not valid. It is a useful exercise, but often now fraudsters are using valid emails, valid numbers we won't see the name of the individual, we won't see the picture. So it's of limited use, but it is of some use. And so it may be worthwhile to look at that. On the corporate side, corporate ID theft is also there. It's reduced by the new Ontario Business Registry Act. However, when it was first introduced, they followed the old principle that they had when they had registry offices. Anybody walked into a office, basically with the right form, properly completed, right amount of money, it got filed. When they first introduced the new business registry, is basically they had two suppliers. The suppliers' standards were proper document, properly completed, right amount of money, it got filed. What is the impact of that? Well, the Act basically says the minister shall enter into the record the information for every return or notice received under this Act. That's it. And then it says the minister may accept the information contained in any return or notice filed under the Act without making any inquiry as to its completeness or accuracy. Translated, garbage in, garbage out. And so that's how I can go in if I'm able to file the form and indicate myself as the director of the corporation. I then show up at a lawyer's office with ID, maybe my own ID, maybe fraudulent ID. I have a made up book, and I say that I'm selling the land or I'm mortgaging the land of the corporation. So very interesting to watch it. That's been somewhat limited because now we have the company key, which is like the PIN for a credit card. So Form 1s are a little more difficult to file, but they're there. Look at not only the corporate profile report, but also look at the filing report to see how long that filing. The more recent the Form 1, the more questions you should be asking. There are a number of resources here on what to do if you have good funds or not, social engineering and so on. And with that, I thank you very much and turn it back over to you, Sophia.
Thanks, Ray. I know when we do this presentation in person, people quickly take out their driver's license to check some of the tips and tricks that you shared. I bet you half of the folks ran and got their wallet. Next up, our third topic is transfers between related parties. Tanis Wall is principal lawyer at Wall & Co. Professional Corporation, and Tanis is going to share her knowledge and expertise on this topic.
Thank you, and good morning, everyone. So I'm talking about title transfers today and the minefield that they can present to a real estate practice. So if you're a real estate lawyer, this call is going to sound familiar. Hi there, I'd like to add myself to my mom's property. No, we definitely don't need two lawyers, and this needs to be done really quickly and really cheaply. So if you haven't had that call yet, trust me on this, you are going to get it. And then you're going to get it again and again and again. So I'm here today to spread the message that we have to treat these title transfer transactions as more complex than a buy-sell. And that's because if you get sued on a title transfer, you're going to want protection from that lawsuit. But even more importantly, it's about making sure that you're always looking out for the vulnerable clients because they are the ones who are most susceptible to losses on a title transfer. Now, I can cite you a bunch of rules of professional responsibility, and I can cite you a bunch of cases, but I think this point hits home the most with an example. So let me tell you about Nigel. This is part of his life story and how his generosity ended up with him at the Court of Appeal. So for Nigel's situation to make sense, I have to go back a few decades and start at the beginning. Nigel had a long-term partner over multiple decades who passed away in 2010. At the time, they shared a condo, which they held as joint tenants. And as is the case with joint tenancy, the property transferred to Nigel upon his partner's death, through the right of survivorship. After his partner's death, Nigel sold the condo and purchased a house in Port Hope. As is the case with many familial relationships with in-laws, Nigel was quite close with one of his partner's family members. That was a niece, and her name was Lori. About a year after his partner's death, Nigel decided that he wanted to ensure that Lori got the house after he died. Instead of just addressing this in his will, he decided to add her to title to his home so that the property would transfer to her upon his death with no probate tax. So he called a real estate lawyer to effect this transfer. Nigel retained a lawyer who added Lori to title as a joint tenant. The lawyer never discussed options with Nigel or the risks associated with adding someone to title. And there was no evidence of any kind that any ILA was recommended. No trust agreement was discussed. No deed of gift was discussed. No discussion happened whatsoever about what this kind of transaction actually means. So the title transfer was completed in 2012, and nothing much happens for close to a decade. Nigel is still close with Lori, and they still see each other with some regularity. Then, in 2020, Lori comes over to Nigel's house with her husband. And while Lori is out of the room, Lori's husband starts telling Nigel that Lori is going to sell the house. I think we can all imagine how distressing a conversation like that would be. Nigel, like many homeowners, is not in the position to be involved in high stakes and expensive litigation, but he knows that he needs to do whatever he can to try and protect his home. As it turns out, Nigel has two very dear friends, Anne and Ruby Rosenblatt, one of which, of course, happens to be a real estate lawyer. So Ruby looks at the whole matter, and he realizes that the only way to stop Lori from taking any steps to dispose of the Port Hope property is to bring an application for a declaration that Lori is holding the property in trust for Nigel, and that Nigel is the 100% beneficial owner of this property. However, we know that litigation is both expensive and time-consuming and very stressful. So it's not going to be the option that everybody can choose. So while Nigel is deciding whether he's going to proceed with the litigation, he decides that at the very least, he's going to sever the joint tenancy. So at a minimum, if he does pass away, at least half the equity in the Port Hope property will go to his heirs. You could characterize this action as him trying to mitigate his damages. So Nigel comes to me and we sever the joint tenancy. Severances of joint tenancies are one of the easiest transfers that we can do because a joint tenant in Ontario has a unilateral right to sever a joint tenancy, and there is no statutory intervention on that right as there is in some other jurisdictions. 2 years ago, I wouldn't have thought that it was important to clarify this universal right in Ontario, but it was a live issue in the application and at the Court of Appeal. The court has confirmed that this unilateral right continues to exist despite Lori's position during the litigation. So after the severance, Nigel decides that he's going to proceed with litigation and seek a declaration that Lori was holding the property in trust for him. This is going to be an uphill battle. The lawyer who added Lori to title has died, and the only documentary evidence available for the transaction is the registered transfer. In my mind, and I think it was the same for everybody else who was a part of this case, the question was simple. Is there evidence that the presumption of the resulting trust is rebutted? But as we know, not everything is as simple as it seems. So at the application stage, the court made extensive findings of fact that Nigel never intended Lori to have an interest in the Port Hope property over the course of his lifetime, and that he only added her to title for probate tax avoidance and for no other reason. He finds Nigel's evidence to be reliable and credible, but he also looks to other evidence like the fact that Lori never contributed to the purchase of the property, she never lived at the property, and she never contributed to ongoing costs associated with the property. The land transfer tax affidavit in the transfer listed the property as a gift. This was a point that was heavily relied on by Lori during the application and the appeal. But it was Nigel's evidence that the lawyer never explained what that actually meant, what he was giving up, and what would happen if he changed his mind about gifting the property to Lori upon his death, which is exactly what happened. One of the other findings of fact that the court made at the application stage is that Nigel's evidence about the discussion with Lori's husband wasn't refuted. While Lori's husband does file an affidavit as part of the application materials, It doesn't dispute Nigel's narrative of the events. In fact, it doesn't even mention it. So once the application is commenced, Laurie ends up taking the position that Nigel didn't have the right to sever the joint tenancy, nor does he have a resulting trust claim. Laurie was relying on the position that Nigel's partner always intended that Laurie would get 50% of the partner's estate, and that the three of them, Nigel, Laurie, and the deceased partner, had an understanding about this. There is no evidence that that was the case other than Laurie's assertion that it was. And the court finds that there was a resulting trust. In other words, Laurie was holding the Port Hope property in trust for Nigel. The application judge finds that the transfer was gratuitous, which means that the presumption of a resulting trust applies, and the onus was on Laurie to demonstrate that the transfer was a gift. Based on the findings of fact that the application judge makes, he does not find that Laurie is able to rebut that presumption. From there, the court goes on to make other findings that have not been made in Ontario before. The application judge views the joint tenancy as consisting of two parts, the joint tenancy itself and the right of survivorship as a separate and divisible component of a joint tenancy that is capable of being viewed in isolation. As a result, the application judge finds that there is a resulting trust during Nigel's lifetime, but also that Nigel intended to gift this right of survivorship. The court goes on further to state that Nigel has the right to transfer or encumber the property during his lifetime because of the resulting trust, but that gift of the right of survivorship is irrevocable, and Laurie is entitled to whatever equity is in the property at the time of his death. Now, at this point, you might be asking yourself, but how is Nigel ever going to access that equity in the Port Hope property? It's very, very unlikely that a lender is going to advance him funds without Laurie's consent if she's on title, and we can probably assume that that consent will not be forthcoming, and the same issue arises with a transfer. So at this point, Nigel has been partially successful. The findings of fact have been made, and there is a resulting trust. But what do we do with this idea of this gift of a right of survivorship and its existence as a standalone concept? The options are to appeal, but again, litigation is expensive and time-consuming and really stressful. So in this case, it's actually Laurie who's the one who ends up appealing, and the matter goes in front of the Court of Appeal in 2024. I watched the submissions of counsel in the appeal, and I can tell you that the justices were really engaged and had a lot of questions. It seemed like we were going to get a lengthy decision regarding how the matter turned out, and in December of 2024, that's exactly what happened. The Court of Appeal first determined that all of the application judge's finding of fact are to be treated deferentially, and these findings were well supported on the record. The Court of Appeal also confirms that the severance of the joint tenancy brought the joint tenancy to an end, and furthermore, that there was no basis to find that the right of survivorship remains in effect as to the 50% interest of the property after we registered the severance. The Court of Appeal also noted that Nigel's lawyer never explained the consequences of the transfer at the time. In other words, what he was giving up. And I will come back to this a little bit later when I talk about how we can protect our clients. On the law, the Court of Appeal affirms that the analysis of finding that there is a resulting trust, but the court also finds, and really this is the most important part of the decision, a joint tenancy and a right of survivorship are not distinct. So when you sever a joint tenancy, the right of survivorship is gone because the right of survivorship is simply an attribute of a joint tenancy, and it does not exist on its own. In the Court of Appeal decision, the court then goes on to ask for submissions on what changes are required to the application judge's original decision in order to affect the determination that Nigel is 100% beneficial owner of the Port Hope property. Nigel submits to the Court of Appeal that they revise the application judge's decision in order to have the property vested in Nigel, which they do in January of this year with their supplemental decisions in this matter. However, and this will be interesting to anyone who's registered a court order before, the supplemental order does not reference the legal description for the property and only refers to the draft vesting order that Nigel submitted as a footnote and doesn't attach it to the reasons. So what does that mean? Well, this means that the order is not in registerable form, and Nigel's counsel needs to go back to the Court of Appeal and ask them to sign the vesting order so it is in registerable form. So back Nigel goes to the Court of Appeal requesting the vesting order. And today, I'm happy to tell you that the Court of Appeal signed it, we registered it, it was certified by the Land Registry Office, and Nigel Jackson was the sole owner of the Port Hope property until it was sold last month. So this story has a happy ending for Nigel, but it just as easily could have not been, given the length of time it took to get resolved, the cost of moving forward through the stages, and Nigel's ability to continue on with the litigation. So while it is the just result in my view, it cost a lot to get to the finish line. And it really is this cautionary tale regarding legal advice that's provided when we're effecting title transfers, because I am convinced that if the lawyer who added Lori to title was still alive, he would have been a part of this litigation. So what does Nigel's story mean in the context of how we advise clients on title transfers? Well, title transfers, as I mentioned at the outset, they're just not simple transactions, and great care needs to be taken with them. If they go well and all of the parties are happy, you won't ever hear about it ever again. But when relationships go off the rails, the aggrieved party is going to look to the real estate lawyer to be made whole. So how do we protect ourselves and our clients? Well, first, we need to charge appropriately for these transactions. The due diligence required from the outset is more significant, in my view, than a standard purchase. And you have to treat them that way in terms of your fees and your process. And it's not a bad idea to be immediately suspicious of a request from someone who's looking to effect a gratuitous transfer, especially if it's the donee who's contacting you. So in the materials, I have 4 precedents that can aid you with your title transfers that I use every time we do one of these transactions. So the first document is called Why Adding Your Kid to Title is a Bad Idea. I drafted this about 5 years ago after I got tired of having the same intake conversation over and over again because some financial planner or a cousin suggested that this was a good tax avoidance strategy. Please feel free to use it. It sets out the risks of gratuitous transfers, and I would say 7 to 8 times out of 10, I convince mom and dad not to do this. Oh, and it's often the child who's calling you about getting themselves on title, which in and of itself should be a red flag. And it raises issues of whether a joint retainer is even appropriate, given the vulnerability and risks to mom and dad, or both. Now, I should also note that in the document, I go through the options of having a trust agreement in place to protect the interests of mom and dad, or whomever it is that is disposing part of their property. But keep in mind that there is an issue with the party being added to title. A trust agreement is just going to be evidence that the property was intended to be 100% beneficially owned by the donor. While it's really good evidence, it does not protect against litigation or unilateral actions on the part of one title holder. Basically, if impecunious little Johnny, who was added to title, ends up bankrupt, or his spouse is claiming that the interest was Johnny's despite the trust agreement, the donor is still going to have to defend against those claims. The only time the donor doesn't have to defend against those claims is when they never added anyone to title in the first place. And that will always be the best protection for the parent. Of course, that doesn't include equitable trust claims. So for my examples, I'm using parent and child, but I've been contacted by nieces, nephews, cousins, caregivers, neighbors, and friends. So it's certainly not limited to parent and child. It's not even limited to familial relationships. The farther you get away from parent and child, especially if you're contacted by the donee alone, the more due diligence you have to do. So the longstanding client who wants to add their only child to title as an estate planning mechanism when their entire estate is already going to the child and the donor is in their 90s, that's a very, very different inquiry than the neighbor of the donor who found you on Google and tells you that their neighbor promised the house to them and now they want to effect the transfer. And they definitely don't want 2 lawyers involved. So the next 2 precedents are the deed of gift and trust agreement. Pre-COVID, Ray LeClaire and I crowdsourced a trust agreement and deed of gift for this exact reason, to protect both client and lawyer in the title transfers without consideration. So those materials are still really relevant and useful today. I've included them in the materials. And lastly, I've included an omnibus waiver that acts as a complement to the other materials, which is a waiver of tax and family law advice, as well as a declaration that the property isn't being transferred to defeat creditors. So this is what I use when, despite going through all of the risks of a title transfer of this nature, I get instructions to proceed and I'm prepared to do so. Now, you might be asking yourself, Panis, Nigel's story had nothing to do with a fraudulent conveyance. Why are you including that in your waiver? And of course, you would be right. But my standard practice on all title transfers, whether it's a whole or a percentage of the property being transferred, is to have a confirmation that the client is not transferring the property to avoid creditor claims as a protection for myself. I am not suggesting that's necessary to meet your standard of care, but I am a firm believer that if there is an option to protect yourself against an allegation of negligence, why not take it? So Nigel's story had a good outcome, but at what cost? A significant amount of legal fees and stress, and all of that could have been avoided by not proceeding with the transfer in the first place, or at the very least having a trust agreement in place. Many residential real estate clients have tunnel vision when it comes to minimizing the fallout, minimizing tax, but the fallout from a title transfer can be far more significant than the arguably small amount that they will save in probate tax. If you're going to effect a transfer like this, be absolutely sure that you've provided advice on the consequences of the transfer and that that's well documented, and consider whether ILA or ILR is required. Lastly, don't be afraid to charge appropriately for these kinds of matters because there's a lot of work involved in them, a lot more than a basic purchase. And if you want to know more about Nigel's story, the case is Jackson and Rosenberg. Thank you.
Thank you, Tanis. Our final topic is sale transactions involving separating couples. Vanessa Narsing is associate lawyer at Walker Head Lawyers. Vanessa, please share do's and don'ts with us.
For sure. Good morning, everyone. My name is Vanessa Narsing, and I'm a real estate lawyer here at Walker Head Lawyers. Tanis, I have to just commend you. I now might have to go back and reconsider all the title transfers I've done in the past between parents and children. So thank you for that. So this morning, my topic is presenting on couples that are separating. So I'm going to share my PowerPoint with you all. I apologize as I'm not as tech savvy as I once was. So this morning, I'm going to be exploring the topics of complexities and risks that arise in sale transactions between separating couples, especially when emotions are high, communication is strained, and there's a lack of clear legal direction. So this morning, I'm going to cover a couple different topics, including common pitfalls that you might be presented with when dealing with separating couples. I'm going to rely on some of my experience with files that I've worked on. I'm going to give you some tips, the do's and don'ts. I'm going to discuss how to create a robust retainer agreement and some supplementary acknowledgements. We're going to talk about communication protocols between separating couples, when and you should and should not withdraw from acting on behalf of the separating couple, and some key takeaways for you to put in your back pocket as you navigate these separating couple transactions. So let's talk about these couples that are separating. They are particularly high risk, and these aren't your typical real estate transactions that you might normally deal with. The reason why separating couples become a little bit more high risk is that you're dealing with highly emotional circumstances in couples. So there's the increased potential for miscommunication in the sense that they say one thing to you and then they don't recall what they said to you because they're caught up in their drama. You might have parties that have conflicting interests because one party of the separating couple requires the funds immediately, while another party is willing to sit back and let the matter unfold. So how are you to maintain neutrality? Sometimes you might be presented with a documentation, whether it be a separation agreement or a court order, and it's unclear and ambiguous around how the funds are to be distributed. But more importantly, you as a real estate lawyer might become unintentionally caught up with all the drama between the parties. So it's important to maintain neutrality and make sure that you navigate these separating couples by following the clear direction and ensuring that you're following your due diligence. So a lot of the claims that you could potentially face is that a real estate lawyer is deviating away from the documentation delineating how the funds are to be distributed. It could be a situation where you, as a real estate lawyer, are feeling the pressure by one party to release funds. Even in the most well-intentioned decisions could breach your obligation if you contradict an existing order or a court order. So I'm going to talk about buyout scenarios along with couples that are separating in your typical sales. But let's talk about some real world examples. So your couple is separating and they've made note of this to you, and there is no formal separation agreement. So you're stuck there. It could be the situation that you are presented with an agreement, whether it was signed between the parties in the absence of legal counsel, or there was legal counsel with one party and the other party was unrepresented. And by way of an example, yesterday morning, I met with some clients who have a sale closing tomorrow, and I had been advised that there was a separation agreement pending and that it would be executed. So all of last week, I followed up and I said, it would be helpful if I had a copy of that separation agreement so I could ensure that when we met to review the sale documentation, that I was very clear about how the funds were to be dispersed. So of course, at 12:30, I received the signed separation agreement with a meeting starting in about an hour later. So my team and I, we reviewed the separation agreement, and what I thought was very clear about how the funds were to be distributed, I did the math and I prepared my redirection of funds. Only to realize that during the meeting, the parties were completely oblivious to what they wanted and that the agreement did not communicate exactly what they were expecting. So I spent a little more extra time, but it was warranted to do my due diligence to ensure that we were clear about how the funds were to be distributed. Because the separation agreement had stated that wife was to get half the proceeds plus 500 less 1,500, while the husband was to receive half the funds and do the reverse of the funds. So I did the math, I double checked it, it seemed right to me. But of course, they said, nope, that's not what we wanted. And then I felt like I had to almost redraft the intention of the separation agreement. But it was worth the time and effort because I got it resolved. And I documented that by putting it into a separate redirection, confirming exactly the amounts that were to be dispersed. So that was a safe on my end. But you might also be presented with couples whereby they're holding title as joint tenants. So naturally, the funds are to be divided down the middle. But then you have one party disputing, nope, I'm entitled to more because I put down a greater down payment, I took out extra money for the house renovations, etc. So if you find yourself in this situation, you need to stop, drop, and don't do anything until you figure out how to navigate that. You could also be in a situation that as a lawyer, you are presented with one party signed direction as to how the funds are to be released. So again, if you found yourself in any of these situations, my advice to you is stop, drop, and don't do anything. So what should you do if you want to avoid getting a claim against you? Well, first and foremost, it's important that you probe early on when you're dealing with a separating couple. So ask yourself, who's the referral source? How did these clients come to you? Are you acting for one of the parties, or is your firm acting for one of the parties in the matrimonial aspect of this transaction? And if that is the case, make sure that there is a clear direction that both parties, alongside their family law counsel, are agreeable to retaining you as a real estate lawyer. Now, it could be the situation whereby you've met with the clients and you could already sense that there's some tension, there's some animosity. One of the parties is going to be resistant. At that point, it may be wise for you to reconsider acting for both and perhaps recommend that they get a second real estate lawyer whom you're going to be working jointly with to close the transaction. And it's important to do this due diligence and to probe early on because it will avoid a lot of stress down the road. Now, assuming you're good to go, both parties are agreeable and cordial to retain you, it's important that you delineate how you're going to act for them. So in your joint retainer, if you have your typical one that you use on a sale transaction, I recommend that you prepare something a little bit more robust, a little bit more intense to confirm your capacity as a real estate lawyer and what you are not going to be doing, and also what you will not be providing in terms of family law advice, estate law advice, etc. So it's important to have clear retainer language and supplementary documents, which I'm going to make mention to momentarily about what my firm uses. It's important that if you're aware that there are family law lawyers involved, that you're communicating with them, keeping them up to breast, or confirming who and where that you're going to provide the final trust ledger to. And recently, what I encountered was typical buyout scenarios using two lawyers. So it's really important if you are not doing a typical sale transaction with a formal agreement of purchase and sale, that you have two lawyers when acting for one party buying the other. So let's speak a little bit more about the retainer agreement. So use your typical retainer agreement, but what my firm uses to protect ourselves, which we have found very effective, is we've created an acknowledgement document. And I'm happy to share that in my materials following this presentation. So in our acknowledgement, we confirm that we are acting equally and jointly for both parties, and that our role as the real estate counsel is limited to providing real estate transaction advice, to preparing closing documentation with respect to funds, etc. And we specify specifically, we are not providing any family law advice, and we are not commenting on items including but not limited to asset division, spousal support, child support, anything to do with the family law aspect. What's more important that we cover in our acknowledgement is we state that the net sale proceeds, so after mortgage payments have been made, the real estate commissions and legal fees pertaining to the real estate transaction have been paid, how the funds are going to be held. So the written direction states that funds will be held in trust until we receive a signed direction by both parties, not one, but both, or a signed direction from each of their respective matrimonial lawyers, or upon receipt of a valid court order that states how funds are to be distributed, or finally, a signed separation agreement by both parties. So this has worked effectively for our firm because I made the mistake early on in my career of not having this. And then, of course, the accusations followed months later, and I had nothing to protect myself. So again, having a very robust acknowledgement, supplementary or in addition to your typical joint retainer, will protect you in the long run. So moving along in the transaction, you've worked out the fact that you've been retained jointly and that both parties are agreeable to using you. How do you maintain communication with them? More often than not, I'll have one party email me asking a question, whether it's about anything to do with the transaction, and they intentionally have excluded the other party. More typically, too, I'll have somebody call me asking me questions about funds or what have you, and again, excluding the other party. So the best way to protect yourself and avoid having any accusation that you're favoring one party over the other is to ensure that you always have an email thread with both parties copied for full transparency. So even a one-sided communication can come across as being biased. So summarize any phone call discussions by way of an email to both parties. If one party sends you an email, make sure you respond to both parties, indicating what the original question was and what your response is. So again, protect yourself alongside every step of the way to ensure that there's no accusation that you favored one party over the other. So let's talk about buyout scenarios. So sometimes one party wants to hold on to the matrimonial home, so they're going to buy out the other party's interest. And if this is the situation, always have two lawyers involved, whether or not there is some consideration passing between the parties. It is important that you protect yourself to show that you're acting for one, while another lawyer has the best interest of the other party. So in a buyout scenario, it's not a typical sale transaction, but in my view, it should be treated similar to a sale and a purchase. Therefore, you have the two lawyers and you're discussing what documentations are required alongside how the funds are going to be held. So in a buyout scenario, for me, the most important thing that could potentially raise concern about a potential claim is ensuring that you have the appropriate undertaking. So as you know, undertakings is like gold from a lawyer, and it must be from a lawyer and not from a client. So if I'm acting for a client that's being bought out, so receiving funds, I want to make sure that the other lawyer has provided me with your typical sale documentation. So obtaining a discharge statement for the mortgage, the lawyer's undertaking that they are going to pay the mortgage funds outstanding by virtue of the refinance funds, assuming that's the case, or if it's from personal funds from the client, and they provide a trust ledger to confirm this. And also the lawyer's undertaking that they are going to discharge the mortgage on title, just like in a standard sale. And of course, the other items that go along with that is to ensure that the home insurance is still active up until the transfer has been confirmed and ensuring that the discharge has been made. And the reason why these undertakings are important is because it does have some legal implications to your client. And I'm going to share an example that I recently experienced a few months ago, which was very unusual for me, but I anticipate that this will happen a little bit more often in the future. So my firm was acting for the ex-husband, and this file was referred to me from our family law department. So our family law lawyers in our firm were acting for the husband, and he was being bought out by the ex-wife. So I requested the standard documentation from the wife's lawyer, and I got everything, including her undertaking that she was going to pay the mortgage and obtain a discharge of charge. So we received that in our file. We were good to go. We closed that. Approximately 2 months later, the client came to us and said the mortgage is still outstanding, and we had no idea, only to realize that when he put in an offer on a new property, his financing clause fell through because he was still associated with the old mortgage, and we thought that was odd. So upon consistent follow-ups with the other lawyer, it came to our knowledge that the ex-wife had not made her last mortgage payment, and this was contrary to the clause in the separation agreement that specifically stated she was to make the last mortgage payment up until a certain date. And even the discharge statement that was provided by the bank, the lawyer had promised and proved on their trust letter that they paid everything in full. So we followed up with the other lawyer and we said, hey, please make sure your client makes this payment. And of course, the other lawyer came back and had excuses from her client saying, no, she's unable to make the payment, she's out of town, et cetera, et cetera. But we, as lawyers, in order to protect our client, was not accepting that. So we basically, I don't want to say we kind of strong-armed her, but basically we had to say, listen, you gave your personal undertaking, you must follow through on your word. So in the end, that lawyer ended up paying out of her own pocket the last payment for the mortgage, which in all honesty was probably a lot cheaper than having her make a LAWPRO claim. So the moral of the story is make sure that you follow up on the undertakings provided by the opposing counsel. So never assume that undertakings are automatically going to be fulfilled. It's important that you document and follow up any discharges, just like you would in a typical sale. So diarize it on a buyout transaction. If the other lawyer gives their undertaking, and it's not like a typical undertaking for registering a discharge of charge, ensure that you review it carefully to ensure it's properly worded and comprehensive, providing a timeline, providing action that's required by a certain date. Always maintain a clear paper trail between you and the opposing counsel to show that you've done your due diligence. I think I could have potentially faced a claim even from my client if I hadn't on a, every day, well, started off weekly. And then when they weren't responding, I provided like daily updates or follow-ups to the other lawyer. So you want to make sure that you have everything documented and show that it was time sensitive. And like I said previously, undertakings are personal. You can't have a client say, oh, I'm going to undertake to make the mortgage payment by such and such date. It doesn't work like that. It's got to come ultimately from the lawyer. And of course, any failure to comply with an undertaking is a serious breach of professional misconduct, something that the Law Society does not take lightly. And of course, you don't want to be making that call to LAWPRO if you know that you've done something that you shouldn't have or didn't follow through on. So what's great about LAWPRO is they have helpfully prepared a undertakings checklist, which you can find on their website. And that is very helpful for ensuring that you've got standard wording, compliance steps, and everything else that you should put in your back pocket to ensure that you have a properly worded undertaking to protect yourself and your client. So now I'm going to revert back to what I was talking about outside of the buyout scenarios, but talking about when you're helping clients who you think you've worked along the way. So you've established your joint retainer at the beginning, you've worked through it in the middle in the sense that you have been clear in your communications. And now we're finally going to get to the piece about the end of the transaction. So if you find that you are put in a situation whereby you are not able to act equally or jointly for the two parties, that would be a clear indication that it's time to withdraw if a conflict arises. And to give you an example of that, I had clients about 2 months ago, and they were selling, and they're very cordial, or to me, they seem very cordial, and they were referred to me by the family law department again at my firm. So we had our sale signing appointment 2 days before this actual sale closing, and everything was good. I was advised that a separation agreement was pending and that I would have it executed by the time of closing. So that was reassuring to me. I'd be able to disperse funds. I wouldn't necessarily have to hold it in my trust account. Now, a week before closing, I received mortgage instructions in the name of the ex-wife. So I reached out to her and I said, hey, I got these mortgage instructions. What's this about? And she then advised me that she was actually purchasing and the closing date was scheduled as the same day as the sale. And I thought, okay, well, this is a little unusual because I really shouldn't be acting for you as your real estate lawyer because you have another family law counsel, and I'm acting really for both of you on the sale, but ultimately our firm represents the husband. But knowing that we were a week away from closing and the sale proceeds were going to be in my trust account, it just made sense that my firm would act for both, and that I would hold the funds just to, avoid any waste of time in getting funds on her purchase. So everything was kosher. We met, we signed the documents on the sale, the husband left, and then it was just the wife and I. But during that meeting, the husband alerted me to the fact that a signed separation agreement was not happening. There were a few kinks that they had to work out, and that in fact, I'd have to hold the sale proceeds in my trust account on the sale. So immediately my spidey senses are going off, and I'm thinking, okay, how is this going to translate into her purchase? But again, the purchase does not concern the ex-husband. While he was aware of the purchase, the actual transaction in and of itself did not involve him. So after we finished our sales meeting, I went back to the wife and I said, okay, so what are we going to do about you getting the funds to close on your purchase? And she said, I can't. Like, I'm going to be like, I can't. And her sellers weren't going to provide an extension so she can work out the kinks on the separation agreement. So at that point, I knew that I couldn't necessarily act fairly for her, knowing that the ex-husband was sort of the reason why the separation agreement wasn't going to be signed, and I had to take a step back. So I essentially had to withdraw from acting for her on the purchase. I didn't leave her hanging because I never do that to any of my clients. And I provided her with a series of names of real estate lawyers, and sort of had to redirect her and say, hey, good luck, and I hope that things work out. So for me, that was a situation where I was acting for separating couples, and I can no longer act on a purchase because of the lack of the separation agreement. So if you feel that you're unable to maintain neutrality, it's important that you avoid taking sides and you sort of step aside, but it makes sure that you don't prejudice your client's rights by leaving them hanging. So in the event that you have an irrevocable direction, so now let's just say that you have a signed direction from both parties with respect to how the funds are to be distributed, it's important that you treat that signed irrevocable direction as binding, and it cannot be overridden. So making sure that with an irrevocable direction that it's signed by all parties, you're treating it as though it's law. And if you're unclear about something, make sure you seek further direction from your clients. And if it goes contrary to the separation agreement, ensure that you do another follow-up direction by specifying the amounts, even if you have to act like a mathematician and go back to the clients to ensure that it's all accurate. And if you're not sure, don't release funds. I mean, at the end of the day, your license is on the line. You don't want to be dispersing funds in contrary to what was stated, as that would lead to a potential claim because one party will come after you. So to wrap up and to finalize, what are some key takeaways that you can put in your back pocket when you're dealing with separating couples? Well, let's review. Ask questions very early on to confirm that it's appropriate for you to be acting on both parties. And if not, it's important for you then to redirect and seek a second real estate lawyer. Ensure that you have a very detailed retainer outside of what you typically use in a sale transaction. So even if that means preparing a verbose supplementary acknowledgement, clarifying what your role will be and what it's not going to be. Communicate equally to both parties. Never favor one party over the other. Never assume content on a written separation agreement. So again, if you're unsure, you're unclear, make sure that you go back to the parties, clarify the exact amounts, and even follow up in a separate direction, confirming the amounts and having them sign off on it jointly. If you're dealing in a buyout transaction, treat it like a sale. So get the respective documentation, make sure you follow up on the undertakings, document your communication with the opposing counsel, and always ensure that you follow up with your client in writing, even if you think everything's clear and communicated between both parties and somebody brings up something, make sure you document in writing to protect yourself. And of course, when in doubt, don't release funds. It's important for you to hold those trust funds and figure out what to do if you're unsure. So that's it for me. Thank you very much. And I just want to make one plug for one thing. If you're in the Durham region, or if you're close by to Durham, on Friday, October 24th, the Durham Region Law Association is hosting a fall conference. We have a real estate segment, and the Director of Titles will be there. So if you're looking for some one-on-one conversation or an intimate setting to ask your questions to the Director of Titles, I encourage you to check out our website and purchase your certificate, and there is CPD accreditation for that as well. So thank you.
Thank you, Vanessa. And Ray and I will also be there. So if you're in Durham, come out. What was I going to say? I was going to say, if you're in a situation where you are holding funds and you are stuck between a rock and a hard spot, you damned if you do, you're damned if you don't. One spouse is saying release the funds, the other one say you can't, I'm going to bring a claim against you, and you're not sure what to do. You could file a notice of a claim at LawPRO. If you're really unsure, you want to have a conversation, you can write to practicepro@lawpro.ca. It's a small group of people that receive those questions. Ray is one of them, I am one of them, and we can't give you legal advice, but we can certainly have a discussion about what is going on. Okay, we are in the question and answer period now. We don't have too much time, but if Tanis and Brendan, if you can come on screen. Okay, Tanis, this is a question for you, and then Brendan, I have a follow-up question that's kind of along the same lines. Tanis, we get this question sometimes, I wouldn't say all the time, but periodically. Can you share your thoughts on a transferee insisting to waive the right to title insurance and solicitor's opinion on title? This usually happens when it's a transfer between family members, regardless if there's consideration or not. What would you do, and what is your suggestion?
Yeah, so I understand this. It's because they're trying to save money. I think it's a terrible idea. Ultimately, there's sort of two things to think about here. If someone is asking you to do this, you may want to consider whether you withdraw and just tell them that you're not prepared to act for them. The problem is there's an interplay of rules of professional conduct here that could prejudice the parties, and you have to be mindful of that. So that's the consideration on the back end if you haven't dealt with this in your retainer. But I think the most important message to get across here is that there's a really easy way to manage this problem, and that's by having robust retainer materials from the outset, as Vanessa talked about, as the materials that I provided as well. So how you deal with that is set out what the process is going to be. Either title insurance or report on title. And in this case, if these parties are going to be prejudiced by you withdrawing, you may have to consider eating the cost of the opinion on title or the title insurance. And you only want to find you are only going to find yourself in that position once. You'll make that mistake once, and then you'll never make it again.
Thank you, Tanis. Brendan, can you shed some light on title insurance coverage in relation to transfers between related parties? So we're thinking of like parent transfer to child, and later there's a title issue, or family members unintentionally end up staying on title when they should have been taken off, and then later, they've passed away. Anything around those kind of transfers?
Sure. So the title policies have a continuation of coverage section. So what that means is based on defined parties, and the classic example is a parent transferring to a child, the parent's owner's policy will continue to be in effect for the child. What that covers, though, is all title defects and the other coverages as of the date the parents took title. So it's not covering any problems that might go awry in that transfer itself. So that's free, at least. There's no cost to that, but it's not, again, providing coverage against anything that could go wrong, either through a lawyer's error or something that came up following the parent's ownership. So paying for that policy provides that extra coverage. So for example, if the children went on as joint tenants instead of tenants in common, or vice versa, that is not covered by the typical policy coverage. But the Title Plus policy has that very broad E&O type coverage, very expansive. And that would provide coverage to the owner that indirectly covers the lawyer as well. So in those cases, we always recommend, even though it's related parties and there's not a fraud risk on that specific transfer, there are many other issues that can crop up.
If parties present a homemade agreement, a domestic contract they've clearly made themselves, do you have any suggestions on what you would do as a lawyer that's been presented, as a real estate lawyer being presented a homemade domestic agreement?
Well, at that point, I think we have to authenticate the agreement. Usually in those agreements, I mean, that's how I protect myself, by having a supplementary written direction. Like, you're both clearly stating that you want funds to go whatever way it's going. And then I'd have a direction stating that these are the exact amounts based on the net sale proceeds that are to be coming from the transaction. And this is how you want to divide it, and I get them to sign off on it. As a real estate lawyer, I don't try to dabble in the matrimonial law area. So if this is what the clients are instructing me and it's a jointly written direction, I follow through on it. Unless, of course, one party has then expressed concern that they're not sure what they're doing. And then at that point, I'd have to stop and say, go seek family law advice.
Ray, this is a hot question for you. We get this a lot when we go out and present. We repeatedly have lawyers that tell us wires are difficult and it's too hard holding funds for 8 business days. And the LAWPRO policy often doesn't cover beyond a certain amount. And if you haven't held a certified check or bank draft for 8 business days, can LAWPRO consider changing the policy or asking that the OREA language be changed to protect lawyers?
I'm not quite sure what change there was made to OREA to protect the lawyer. First of all, OREA only typically considers changes that benefit their agents, not lawyers. So I'm not quite sure we'd get there, but I'm not quite sure what that change would be that would protect lawyers. Unfortunately, we have the Canadian banking system and it's deficient. Payments Canada is working to get it better. There are rules that, if they enforce, would be make it better. We are constantly, I've been dealing with them now for years, trying to get them to move. They are coming out with a new system, the real-time rail, in probably within a year or so, that is supposed to make things better. Again, the problem is the lack of transparency. As you know, under links, there's a payment confirmation reference number, the PCRN, that is able to confirm that you have actual funds, not just a credit, because 99% of the time when you see the dollar in your account, it's a credit that could be pulled back. If you have that PCRN, it would confirm. If the banks were using that, they could process wires faster, which would remove a lot of headaches, and they would not need to put holes on accounts that are causing issues also. It's a constant use. LAWPRO could change the policy, of course. How much do you want to pay in a premium? And that's what it comes down to, is the risk involved. At this point, I have done presentations on how lawyers can help us make changes. And it's a matter of lawyers asking the banks to comply with their Payment Canada obligations to provide the PCRN. And if we get that groundswell going, then maybe we will have a chance to get the banks to comply with the obligation they know they have, but they basically are just putting off at this point.
Thank you, Ray. All right, we're almost at the end, so I want to thank our speakers for sharing their time and expertise with us today. I also want to thank the staff at Toronto Lawyers Association and LAWPRO working behind the scenes to make this program flow smoothly. This program qualifies for 1.55 hours of professionalism hours and 1 risk management credit towards your 2027 premium policy. The replay of this program, so the recording, will be posted on Practice Pro's CPD page along with the materials. So for the materials, you were probably, or you must have received an email yesterday or the day before. If you didn't, check in your junk, but it will be posted on the Practice Pro CPD page probably today or tomorrow. If you have questions and comments, feel free to reach out to practicepro@lawpro.ca. If you have questions that were unanswered and you have specific to the speakers, and I'm not going to speak for the speakers, I'm just saying very generally, speakers are often open to receiving questions, but please be mindful of their time. This concludes our program. I'm going to turn it over back to the TLA.